Coming up on Market to Market, the worst drought in half a century tightens its grip on America. Disastrous grazing conditions prompt cattle producers to liquidate their herds. House lawmakers approve emergency assistance for livestock producers, but fail to debate the Farm Bill before taking a 5-week recess. Those stories and market analysis with Alan Brugler next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, August 3 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Employers expanded their payrolls significantly last month, fostering sentiment that the U.S. economy may pull out of its mid-year slump. According to the Commerce Department, U.S. employers added 163,000 workers in July. That boosted the monthly hiring tally to an average of 151,000 jobs per month this year. But the gain wasn't enough to drive down the national unemployment rate, which ticked up 0.1% to 8.3%. Notions of increased hiring were welcomed on Wall Street, where the Dow, S&P 500, and NASDAQ all moved sharply higher on the news. Commodity prices also rallied, with crude oil posting a gain of nearly 5% Friday, while nearby corn prices advanced 16 cents and settled above $8 per bushel. Higher grain prices, of course, are due to the worst drought in half a century. House lawmakers approved emergency assistance for livestock producers late this week, but Senate leaders didn't take up the measure and called on the House to move forward on its version of the Farm Bill. Ultimately, nothing was accomplished, and Congress left for a 5-week recess. The U.S. House approved a drought assistance package Thursday on a 223 to 197 vote. That measure would provide $383 million in federal drought assistance for livestock producers. But critics from inside and outside Washington saw the farm disaster bill as a political vote meant to shelter rural congressional Republicans during the 5-week recess. The vote also underscores deep divides over a larger discussion on the 2012 Farm Bill.
Make no mistake, we should be voting on a farm bill, not a drought bill. I have great sympathy for the needs of our cattlemen and those who are suffering from the drought, but I think that this bill is just another indication of we're doing something that doesn't meet the needs of the issue that our economy requires.
Despite the former House leader's criticism, current Speaker John Boehner signaled a full vote on the House Farm Bill version would have failed.
The House is pretty well divided. You've got the left concerned about reductions in the food stamp program. You got the right who don't think the cuts go far enough in the food stamp program to bring it into compliance with what the law has been. And frankly, I haven't seen 218 votes in the middle to pass a farm bill.
Congressional proponents of a new 5-year farm bill argue the current stalemate is unprecedented in legislative history. The Senate passed its farm bill measure in June, and the House Agriculture Committee passed its version in early July on a bipartisan 35-11 vote. But the bill never made it to the House floor for debate. Without full House approval, both chambers are unable to hammer out differences in a legislative conference committee. Meanwhile, emergency assistance is not available for livestock producers besieged by historic drought.
Unfortunately, the disaster programs from the 2008 Farm Bill have already expired, and while the Senate passed a 5-year Farm Bill in June, the House isn't even expected to take action on it.
The nation's largest farm lobbying organization, the American Farm Bureau, was among a long list of agriculture groups giving the House disaster bill a lukewarm reception amid a push for a 5-year measure.
The disaster provisions that are being debated in a standalone bill are exactly the same as what's in the Senate-passed Farm Bill and the House Ag Committee-passed Farm Bill. So it would be much easier and much more expedient if Congress would just finish the Farm Bill.
The August recess may pause congressional wrangling, but the current Farm Bill faces a September 30th expiration date. While the Obama administration strongly supports a new 5-year measure, this fall's presidential political season may push Congress in the direction of a short-term Farm Bill extension. The Agriculture Department announced this week that crop insurance companies have agreed to provide a short grace period for farmers on their insurance premiums. Secretary of Agriculture Tom Vilsack asked insurance companies to voluntarily defer the interest on unpaid spring crop premiums until November 1st. Likewise, the USDA will not require the insurance companies to pay uncollected producer premiums until 1 month later. That's at least a tiny bit of good news for corn and soybean producers facing potential cash flow issues this fall. But fewer livestock producers have coverage, and the Maine Federal Disaster Program for them expired last year. Paul Yeager examined the impact of drought on cattle producers in Arkansas and Kansas this week and filed this report.
The Great Drought of 2012 tightened its grip on America this week as more than half of the continental United States has been declared disaster areas by USDA, mainly due to drought and excessive heat. All told, 1,584 counties in 32 states received the designation, making farmers eligible for low-interest emergency loans. Meanwhile, the U.S. Drought Monitor reveals arid conditions are intensifying, with the vast majority of haying and grazing land locked in the driest conditions in half a century. Hoping to bring relief to weary livestock producers, USDA expanded emergency haying and grazing on close to 4 million acres of conservation land this week. Like so many other producers in the South, Arkansas cattlemen are enduring their second straight year of extreme drought.
This is the worst year that I can remember having been in the cattle business. Last year was a dry year, and we sustained some loss of our grasses in the fields, in the pasture, and in the hay ground, and we cut back our herd to some degree last year, but nothing like now.
Fourth-generation farmer Gary Rowlands of Pope County, Arkansas, says he's endured long stretches without rain again this year, on top of several 100-degree days. And like so many other livestock producers, he's considering selling their cattle simply because they can't afford to feed them.
Just an incredible amount of cattle going through our sale barns. Our local sale barn is typical of the barn on I-40 there at Ozark, over here at Ola, and also at Lewis Auction there in Conway. If you look at the weekly market reports, their sale numbers have been double and triple of this time last year.
And in one of those sale barns, a sale that started at 6 a.m. ran through the night. The reduction in herd size will have long-term impacts for consumers at the meat counter.
The drought is starting to take its toll, and the fact that there's a glut of older cows on the market now, and those cows are selling at a lower price.
Kansas ranchers are also sending cattle to the market during these dry times.
We've started selling pairs, and we will probably sell pairs and try to keep the core of our young herd, or younger cows, in the herd as long as we can. I guess if it doesn't ever rain, they'll all end up in town.
Care for those animals left behind is a big task. Water delivery to dried up pastures takes its toll on producers and the livestock. For Ken Grecian, that could be an up to 5-hour-a-day job.
Their water consumption's probably 20% of what we have to haul now, and it's time consuming to have to continue to haul water. I'm starting to lose sleep over this. I mean, it's serious enough that we have to make hard decisions, and making the right call in a atmosphere like this is sometimes difficult.
The other big consumer of corn, of course, is ethanol. This week, the National Cattlemen's Beef Association asked the EPA to put the renewable fuel standard on hold, saying the mandate is causing severe economic harm.
We'll pay any price for corn as long as the market is driving that price. But with the renewable fuel standard, that's a government mandate that's driving that price.
And while the window to bring any relief to the corn crop is all but slammed shut, producers for other crops continue to pray for rain. USDA's latest crop conditions report estimated nearly half of America's corn is in the poor to very poor category. 1/3 of the nation's soybeans garnered similar ratings, tying conditions in 1988. And as if drought wasn't enough, arid conditions were exacerbated by blistering temperatures.
We've seen record-setting July heat stretching all the way from Denver, Colorado, eastward and northeastward into places like La Crosse, Wisconsin, and Rockford, Illinois. Previous records in some of those communities were set for July heat in 1921, 1934, 1936, some of the truly historically hot summers of way back in the distant past. And that certainly surpasses what we saw in 1988. On top of that, the very same areas of the Plains, Mid-South, and Midwest had record-setting dryness.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
Grain prices were mixed this week as the trade pondered the outlook for intervention by the Federal Reserve and spotty rainfall in parts of the Corn Belt. For the week, September wheat fell 7 cents, while the nearby corn contract rallied back above the $8 mark with a move of 12 cents. Soybeans followed corn higher, with the September contract gaining 8 cents, while the nearby meal contract advanced by nearly $8 per ton. In the softs, cotton also trended higher as the December contract posted a gain of $1.77. In the dairy market, August Class 3 milk futures gained 17 cents, while the deferred contract was up 31 cents. Over in livestock, October cattle lost 90 cents. Nearby feeders were off $1.45, and the October lean hog contract declined by nearly $5.50. In the financials, the euro advanced 65 basis points against the dollar. Crude oil gained $1.27 per barrel. COMEX gold fell $16.70 per ounce, and the Goldman Sachs Commodity Index gained nearly 10 points to close at 647 even. Here now to lend us his insight on these and other trends is one of our regular market analysts, Alan Brugler. Alan, welcome back.
Great to be here.
Thank you. It's been kind of a busy week in the broader market. There's been a lot of longer-term trends that have been going on there. What have you seen affecting commodities prices?
Well, we saw the dollar get a little weaker this week against the euro. That's usually supportive to commodity prices, as you heard with the Goldman Sachs index there. The money's still flowing into the U.S. treasuries out of other places in the world. There's still a flight to safety. You saw some upward movement on the bonds and the notes. They backed off a little on Friday, but lower interest rates are supportive in general to money flow in commodities and equities. So a supportive environment for ag overall from that direction.
All right. And as we look at continued high prices on a lot of the grains, and if we see the dollar's weakening, at some point, is that going to help exports combat these high prices, or what do you think is going to be the bigger driver there on exports? Is it mainly grain prices?
Well, we care more about exports after the growing season. Right now, the uncertainties about the production are the main issue. Once you get past the harvest and you've got a known quantity, or somewhat close to a known quantity at least, then it's more demand driven, and a lot of that, of course, is exports, particularly in something like soybeans. So the focus on the dollar becomes more significant after we get past harvest.
All right. Are there any indications you're seeing out of Europe or anywhere else as to where the dollar may go?
Well, it's all tied into the European debt crisis, or as we call it, the crisis that keeps on giving. It just cycles around. It's Greece, then it's Spain, then it's Italy, and we don't have a handle on that. It's going to be a problem for a while. They've got ongoing issues with government finance and kind of a catch-22 in that if you have the austerity to straighten out your debt problem, you slow your growth and you slow your taxes, which makes your debt problem worse. So it's not going to resolve itself anytime soon. It's likely to hurt U.S. exports to Europe. Okay. It's affecting Chinese exports to Europe as well, which is part of the reason they're slowing down. But
all right.
It's a more complicated problem.
Okay, so we'll keep seeing that in the headlines for the foreseeable future. All right, moving into commodities, let's talk a little bit about wheat. We've been watching the past couple weeks as wheat has just consistently followed corn higher, more or less. And this week we saw a little bit of a break. Wheat, both nearby and deferred, were down a little bit, and corn was up a little bit. Are we seeing a break in that following, or
I think it's more likely just a temporary correction. Wheat's
Okay.
a little more volatile than corn is. It's a higher priced commodity, although they're both up there right now. You've got a Canadian wheat harvest that's already started that looks to be pretty large. You've got, of course, the spring wheat harvest here is early, so you've got fresh supply coming into the pipeline. You're still getting some support out of Europe. The Russians have had some drought issues, but they did come out this week and say that they intend to continue to export. There wasn't going to be a 2010 type embargo on exports. So that knocked the wheat back a little bit. But I think it's a temporary dip. And if wheat drops too far, it works its way back into the feed rations. And I don't think the world market wants that, because we're at a 3 or 4 year bottom, or decline in ending stocks now for wheat.
Okay. So for producers out there, what should they be looking for on price?
Well, I think you have to reward the market with some sales here. This is just historically a high price. We know that in 08 we got higher, but so you don't sell everything. Mm-hmm. We're not encouraging people to sell next year yet, 2013, but we're starting to bump up our sales on 2012 crop.
All right. Any price points out there they should keep an eye on?
Well, I think anything between $9 and $9.50 is a pretty good price to make some sales, and we've had a couple opportunities to do that.
All right, so strike on those with some of your harvest if you have the
Right.
chance. All right, well, let's talk corn a little bit. We're still above $8. What is, well, the drought is the big driver there. What are the other factors that are keeping corn that high?
Well, it's the uncertainty of the production. There's a speculative element, of course. Because it's a story. It's on it's not in the front page of the Wall Street Journal yet, but it's making a lot of headlines. Yeah. And we've got, the real question other than production is on the demand side. How much ethanol cutback are we seeing? And we do have plants shutting down or taking extended downtime. How much is export market shrinking? And it is. And to a degree, what are the livestock guys doing? Are the poultry guys going to cut back? They've been trying to ramp back up after their 09 cutbacks. Are they going to continue to expand? We don't think so. We think that they've seen the writing here and they're going to slow down. All of those need to happen to make the demand fit the production it looks like we're going to have this year.
Okay. In terms of ethanol, as far as the RFS mandate goes, do you foresee any major changes in that going forward?
It appears to me that the political situation doesn't lend itself to a reduction. Okay, the EPA's got certain rules they have to follow. They've got to have a comment period, and there's political issues tied to that. Okay, if you start shutting down ethanol plants, you increase unemployment. You also will probably, in that scenario, increase gasoline prices because you're restricting part of the U.S. fuel supply. So there's negatives to doing it. I think the bigger issue, though, is even if it were to be implemented, I'm not certain that we would cut back on the amount of corn that's being used for ethanol production. Right now, the market is taking the production. The ethanol is priced cheap enough relative to gasoline that we're using it without the mandate. And frankly, if you had this RFS 2 adjustment, ethanol prices would probably drop, and that'd make it even more attractive as a blend stock.
All right, so then we'd see the opposite of the intended effect.
The market would balance out and go on about its way. So I think we should see some reduction in corn use for ethanol, and we are seeing that. But that is being done in the marketplace with the individual plants and the economics of those plants.
All right. For producers out there in the field, any price points they should be looking for? What do you see going forward?
Well, there's a big difference between a 10 billion bushel crop and an 11.5 billion bushel crop. That's going to drive the pricing. If we're closer to the 10s or 10.2s, like we're starting to get estimates, swags I call them, that are that low, then we're not high enough yet. We might have to have an $8.50 to $9 front month futures, at least for a while, if we're towards the lower end of those estimates. Our internal numbers suggest the crop's probably no larger than 133 bushels per acre national average, but we're not prepared yet to go down to the 120s as some folks have done.
117, I think I saw earlier today.
Yeah, we're going to do our virtual corn tour over the next 2 weeks. We'll collect data from anywhere from Texas to North Dakota to Ohio, and we think we'll have a better handle in another 2 weeks.
All right, so pretty much hold off on making any major movements until we get updated figures from the USDA. And
We think you ought to have a few puts in place just to protect your crop insurance payments or to protect bushels that you're pretty sure you're going to have, but you're not willing to commit to a cash sale on.
All right. Well, let's talk beans a little bit. We've had a little bit of rain in some parts of the Midwest, and it's crucial time for beans. What is that doing to the futures markets?
Well, the market's kind of slowed down the upward momentum. We're not exactly falling up out of bed yet, and for good reason. You're definitely seeing some improvement in the crop in Ohio and in parts of Indiana that saw the 2-inch type rains over the last couple of weeks, and in spotty areas of Iowa where you happen to be under the right shower, parts of central Nebraska and so forth. But on the other hand, you've got areas that haven't seen a lick of rain since late June, and the beans just aren't doing anything. We're hearing about some of the early flowers falling off and not potting. So the market's going to have to deal with that. But August, you can still add bushels in August. And so the rainfall this weekend is critical. The rains the first, next 2 weeks are probably critical as to whether that final yield is a 34 bushel per acre or 38 is still to be determined.
All right. In terms of producer advice on beans, it's a wait and see.
It's pretty much wait and see. We've done some three-way spreads. We've got some 16-20 November puts as a price floor. We've sold some $18 and higher calls against those. We've got some downside puts sold just so that if it does suddenly decide tomorrow, okay, we've done enough. Nobody sends you a notice when the market's going to top out. So we think good risk management is to have a little bit of protection in place. Don't need to go heavy on the cash sales here, but have some headline news protection.
All right. Be smart out there.
Right.
All right. Let's talk a little bit about cotton. What are we seeing out there this year in terms of cotton?
Well, cotton's a little more heat tolerant and a little more drought tolerant. Obviously, last year the drought did hurt us down in Texas and Oklahoma, but the yield estimates for this year are still fairly attractive. In fact, we're talking about producing more cotton with less acres this year because of a better yield. Globally, the situation is getting a little tighter, but it's still ample. Cotton's probably my nightmare as it pertains to corn, just because we saw what happened. We went to $2.27 in cotton. Now we're trading it at 70 cents.
And that was demand destruction?
And it was demand destruction and attracting production in other parts of the world. Okay. And as part of that, we had end users, importers in other countries that chased the cotton market higher and then realized they couldn't use the product at that price and canceled. In cotton last year, we had 3 months straight where we had weekly net negative export sales. And we had a net negative corn export sales 2 weeks ago, and it kind of got my attention, although we were back up this week.
All right. So in terms of price on cotton?
We think there's pretty decent support in the 68 to 72 cent range. It doesn't seem to want to go much higher than 73 or 74 right now. So we're not making many sales when it's below 70, but we want to reward rallies.
All right. Well, let's talk livestock a little bit. That's they're kind of feeling the brunt of these high feed prices. What are you seeing on feeder cattle?
Feeder cattle are very much the inverse of the corn market. When corn's rallying, feeders have gone down, and vice versa. They can rally if the live cattle market wants to go. But as you know, we've had a smaller calf crop. We've got the smallest calf crop in 50 years. And last year wasn't a whole lot bigger. So we have a limited number of feeder cattle. Placements have kind of gone from light one month to heavy the next month. But we think that they'll probably pick up a little bit here in the fall, the price, because of what we expect in the cattle market.
All right. And so what are you expecting in the cattle market?
Well, we're looking at extremely tight beef supplies in the fourth quarter. USDA's most recent estimate was in the 92 or 93% of a year ago range. That's a fairly substantial drop off year over year. Our placed against numbers suggested there's a definite drop off in September and October. So from the supply side, we'll have less to work with. That typically is going to drive the price up. You're seeing that with the December futures acting much better than, say, the August.
Mm-hmm. So what are you advising folks to do if they've got feeders or cattle out there? What are you?
Well, basically, we've had hedges on in the feeders from 160 on down. We're starting to lift our puts or roll them down to at the money to take the hedge profits out. starting to look at buying some call options in feeders. We've also had a couple opportunities to do cattle crush spreads in the November placement period where we could lock in a $13 or $15 head profit. So we want to do those. If we can get some more of those on, that'd be great.
All right. Let's talk about hogs. It was a big week in the hog market. We had over the week a $5.50 decline. What are you seeing there? What does the future look like for hog producers?
Well, this is normally a time when you start to see slaughter going down, and that didn't happen this week. We were up year over year and also week over week. So the market's having to deal with a little supply that it usually doesn't anticipate. The cutout values are still the second highest in 10 years. They're not as good as last year, but they're still up there. What we're not seeing is the big export market that we had last fall where China came in and bought some. It's a little early for that if they're going to do it on a seasonal basis, but we're now the export dependent. We export about 20% of the pork that we produce, so we need that export market. The stronger dollar that we had been seeing doesn't help that. The weaker dollar that we saw this week should help us a little bit in the exports. But if cattle start to rally and wholesale beef goes up, the pork will probably follow it.
All right. As far as in the global sense, the markets as a whole, what do you see happening if we get widespread rain in the next 2 weeks?
We'll sell off in that case. That's just but that's almost how can that happen? A widespread, and we're kind of in the mode now where even if you get rain, we're discounting the amount. Okay, well, there was an inch there, but these other guys didn't get it. It's going to be difficult to change that psychology. I heard a meteorologist last week talking about hurricanes. A lot of folks think, hey, we get a good Gulf hurricane, that'll solve the problem. But he said, actually, a hurricane's not what you want. That would tend to precipitate most of the moisture along the Gulf Coast. What you want is a tropical storm, something doesn't make hurricane status, to throw some humidity up here in the Midwest.
All right. Well, thank you so much, Alan. Appreciate you being here. That wraps up this edition of Market to Market. But if you'd like more information from Alan on where these volatile markets may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free on the Market to Market website. Be sure to join us again next week when we'll travel to Illinois, where the harvest of corn, or silage, is already underway. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.